we focus on the latest around consumer activity and the state of credit in South Africa remaining an ongoing concern. That's as food and fuel prices are still elevated despite inflation starting to decrease. Analysts have highlighted that consumers are holding on to a thin thread since having to cope with the high complex credit environment driven by elevated inflation, and that has fed into high interest rates as well as low economic growth. The biggest impact being on lower to middle-income consumers. Chief Risk Officer at Standard Bank, Thabani Ndwandwe, talks to us about these developments. A good evening to you. Do tell us how this has had an effect on the repayment of big-ticket items such as mortgages and vehicle finance, elevated inflation, as well as the high interest rate climate.
Good evening, Rusang, and good evening to all the viewers. Just maybe to start here, I always say I think it's good to understand the context of the world we find ourselves in. If you just think about it, just in 2020, we were dealing a massive blow in COVID. A lot of people lost their livelihoods and their lives. You can imagine if you had a spouse, many of the spouses may have passed on or they may have lost their incomes, which has already put strain on the consumer. In that period, the government, of course, did what I think any good government, as well as the Reserve Bank, did some stimulus packages to help the market, one of which was a drop in interest rates. The interest rate dropped quite significantly at that time, but then that had to come back up. We've seen that increase in interest rates. If you just think about it, in November 2021, if you had a bond, your interest rate would have gone up from then till now by 475 basis points, which is quite a significant number. You can just on a bond, I always like to make this example. On a bond of 10,000 rands, if you're paying 10,000 rands a month, that now is 14,200. That's a 42% increase on someone's payments. So that's a big jump for many people. And remember, at that time, we saw a lot of people who were new first-time home buyers coming into the market, trying to buy properties slightly cheaper at low interest rates. And those people had never experienced increased interest rates. So that has come in and really caused a bit of pressure in the market. Now, I always use there's many matrices we can use, but I like using home loans just because home loans is probably something that's really important for all of us. We want to have homes and we want to stay in our homes. We've seen a growth in homes that have gone into, let's call it a distressed positions, or what we call non-performing loans. We've seen many of the banks releasing their results just now in March. And if you take the total number in the market, that number is sitting at about 98 billion rands of home loans that currently are sitting in at least 3 payments down or some other form of distress. So that's quite a big, substantial number. It's up 36% on average for the industry, just year on year, just from last year. The second metrics I've tried to use is debt review. If you look at our debt review numbers, right now, the industry as a whole, the whole country, the debt review is sitting at around 80 billion rands as at the end of last year. Now, that number is huge, 80 billion rands, because in 2021, we were sitting at 60 billion rands. So you've got now just about a 33% increase in debt review that's just happened over this period, which is a sign that just consumers are under significant pressure at this stage at the moment.
How then does this have an impact on the banks? Of course, yes, with an elevated interest rate environment, it's beneficial because then they have those who service their debt for a longer period of time. However, it cannot be ideal. How do we compound that with those who then are unable to repay that debt?
Absolutely. So there are a couple of things that we've seen in the last while. So impairments, or what we call losses that banks incur when people are not paying. So when you get so many people missing their payments and going to debt review, that of course means that the banks have to hold provisions, which is the losses that they're predicting will come through, and they write off some of these accounts. And that has gone up in the industry, at least for every bank, at least by more than double digits. So that's quite a significant number, but double digits growth. So big numbers of impairments. And what it tends to lead to banks, when they see so much pressure, they start being careful around the credit granting. And we've seen in the latest numbers that we released last week, credit household that has come out in the market is actually now at a negative number in real terms. In actual terms, in nominal terms, it's about 2% or so, but actually in real terms, that's negative. We're now deeply into the negative territory, which means we're not pushing enough credit into the market, which means we're not creating enough stimulus into the economy because you need more credit into the economy to drive home loan prices, to drive stimulus for people to have buying power. So that's what tends to happen in this situation. And so you get a slowdown in the market. We then see that when customers don't get funding from banks, some of the customers start going to micro lenders and actually become slight victims of that. So this is where sometimes there's a catch-22 scenario in the market and creates more further pressure in the economy or for the consumer. Yeah.
And it's on that note where I must ask, as a parting shot, that is there any light at the end of the tunnel? Many of us would want to hear that we are crossing fingers for a near-term outlook where the forecasts are correct, that inflation will continue to gradually decline and somehow we'll get a rate hike.
We're starting to see some positive signs on inflation, particularly we saw towards the end of the year. We've seen some numbers in March that shows that it's a bit sticky. And there are a couple of things that one has to look out for. The first thing is that we know that America released a nice US jobs data this morning, which shows that US data, well, not nice, it's difficult. It shows that America needs more stimulus to improve jobs market, which means that we can expect America to start thinking about reducing interest rate, because about 2 weeks ago, we were worried that they're not going to reduce the interest rate. That helps us as a country in thinking about reduction of interest rates. We are starting also to see that inflation is coming down in South Africa, but we're watching out for election seasons. Election season tends to come, doesn't matter what the outcome of elections are, but what we know, we get negative investor sentiment, which can create a bit of volatility in the rand and push inflation up and may force the Reserve Bank to delay their decision on interest rate cuts. So that might be the thing. Our expectation at the moment is that interest rates will start coming down in the second half of the year, assuming that the global market starts also reducing the interest, as well as we get stability throughout the elections and don't get too much volatility. That will mean interest rate goes down. But I just want to warn this. We've seen interest rates rising up to by 475 basis points since 2021. That is still 200 basis points higher than in 2020 when we went into COVID. So we're not, if I look at the interest rate expectations, I'm expecting at least 100 basis points between now and the next 12 months. So we think that that there'll be 75 this year, between 50 and 75, and then another 25 next year. So that will give us about 100 basis points. Yeah. So it's not even going to take us to the pre-COVID numbers. So I then would say consumers must expect that there will be some relief, but it's not enough. It's not too much. So you still have to think about your options. And my recommendations on options is this. Speak to your lenders. Always engage your lenders as a first resort before you go into this debt review population. Why? Debt review locks out a lot of people. If you're on debt review, it takes you forever to get out of debt review. So then you can go to debt review if you failed on that. And then you can go to the other options. And make sure that you protect your most valuable assets like home loans and VEF, etc., before you do any other things. And maybe downgrade where you feel you need to downgrade. Because I don't think it's going to get easy anytime. It's going to get better, but it's not about to get easy.
Thank you so much for your input. Thabani Ndwandwe is with Standard Bank talking to us about the state of credit in South Africa given the rising cost of living.